Do you know what exactly determines the interest rate you pay on your home loan anyway? Is it just the luck of the draw, or are bigger economic forces at play? Mortgage rates can seem mysterious. Where do these numbers come from, and why do they go up and down? Today I'm going to break down exactly what determines mortgage rates and what causes them to fluctuate. Welcome back to the Billionaire Channel. Let's get into it. At a basic level, mortgage rates are driven by bond yields, especially the yield on the 10-year Treasury note. Basically, mortgage rates tend to follow the same path as 10-year Treasury yields. But why is that the case? When you take out a mortgage from a bank, the bank usually sells that mortgage to bigger investors like Fannie Mae or Freddie Mac. These government-sponsored companies bundle together thousands of mortgages into mortgage-backed securities, which they then sell to even bigger investors, pension funds, insurance companies, foreign investors. These investors are looking for relatively safe investments that provide steady returns. One option is buying U.S. Treasury bonds, which are considered virtually risk-free. Another option is buying mortgage-backed securities, which provide a somewhat higher return compared to treasuries. So mortgage-backed securities compete with Treasury bonds for investment dollars. If the yield on the 10-year Treasury note goes up, meaning bond prices are falling, investors may shift money out of mortgage-backed securities into treasuries. That causes the prices of mortgage-backed securities to fall too. When mortgage-backed securities fetch lower prices on Wall Street, it translates to higher mortgage rates for home buyers. Essentially, investors need to be compensated with a higher return on mortgage-backed securities when Treasury yields rise. Conversely, when Treasury yields decline, making bonds more expensive, investor money tends to flow out of treasuries and into mortgage-backed securities. Strong demand allows banks and lenders to offer lower mortgage rates to consumers while still selling their mortgages profitably to Wall Street. So mortgage rates tend to follow the same direction as 10-year Treasury yields because mortgage-backed securities compete with government bonds for investor dollars. However, mortgage rates don't always move perfectly in tandem with 10-year yields. Sometimes mortgage rates rise more slowly than Treasury yields, or they may lag behind. Other key factors specific to the mortgage bond market can exert pressure on pricing too. For instance, when mortgage lending declines sharply, perhaps due to a recession, there will be fewer new mortgage-backed securities coming to market. That scarcity makes the remaining mortgage bonds more valuable to investors, allowing banks to reduce mortgage rates somewhat. Mortgage rates are also influenced by the market's expectations for future monetary policy set by the Federal Reserve. If investors anticipate that the Fed is likely to cut short-term interest rates, they may move faster to price that into the mortgage market through lower mortgage rates. Now you might be wondering who are the investors ultimately buying mortgage-backed securities and Treasury bonds that sway mortgage pricing? Pension funds and insurance companies in the U.S. are major players, but foreign investors have an increasingly heavy influence as well, especially central banks and sovereign wealth funds. Right now, China and Japan each hold over $1 trillion worth of U.S. treasuries. That means decisions to buy or sell made in Beijing and Tokyo can transmit through financial markets to impact mortgage rates in America. If Chinese officials decided to reduce their purchases of U.S. government debt, yields would likely rise, putting upward pressure on mortgage rates. Global capital flows can have major implications for mortgage rates, sometimes in ways that are hard to predict. This became clear in March 2020 at the outset of the COVID crisis. As the economic outlook darkened, investors rushed to put money into dollar-denominated assets perceived as ultra-safe, like treasuries. This unusual demand shock briefly pushed Treasury yields below 1% and mortgage rates plunged to unprecedented lows in turn. To summarize, mortgage rates are primarily determined by competition between mortgage bonds and treasuries to attract investment capital, namely from pension and insurance companies, central banks, sovereign wealth funds, and other large institutional investors across the globe. When Treasury yields rise, it tends to draw money away from mortgage-backed securities, leading to higher mortgage rates. When Treasury yields fall, it has the opposite effect. But changes in expected Fed policy and other technical factors in mortgage markets can disconnect market behavior from time to time. So why have mortgage rates climbed so much in 2022, more than doubling over the last year? The main driver has been spiking inflation and the Federal Reserve's aggressive policy response. As consumer price inflation surged to 40-year highs following Russia's invasion of Ukraine and continued supply chain turmoil, the Fed felt compelled to hike interest rates dramatically to get it under control. Since March, the central bank has raised its benchmark federal funds rate from nearly 0 to over 4%, the fastest pace of Fed tightening since the 1980s. Higher short-term rates set by the Fed influence longer-term yields like we see on the 10-year Treasury. As expectations built through 2022 that the Fed would need to take drastic action on inflation, yields on longer-term government bonds priced in more and more pending Fed rate hikes, rising sharply as a result. 10-year Treasury yields began 2022 around just 1.5%, but reached over 4% by October. And because mortgage rates tend to follow the same path as Treasury yields, the average 30-year fixed mortgage rate more than doubled from just over 3% in early January to well over 6% as we close out 2022. So in short, the reason mortgage rates increased so dramatically this year all comes back to surging inflation and the Federal Reserve's steep interest rate hikes designed to rein it in by slowing the economy. Anytime inflation seems to moderate, allowing the Fed to ease up on rate hikes provides potential relief to overheated mortgage rates too. Are you looking ahead? Key factors determining the trajectory of mortgage rates in 2023 and 2024 will be the future path of inflation, whether it continues descending from 40-year highs. Less inflationary pressure gives the Fed leeway to limit further rate hikes or even cut rates, which would be a positive for mortgage pricing. How aggressively the Federal Reserve raises or lowers interest rates in response to changing economic conditions. More rate hikes maintain upward pressure on mortgage rates, while rate cuts help bring them down. Employment trends and overall U.S. economic growth. If job gains remain resilient or the economy strengthens more than expected, mortgage rates likely rise. Signs of an impending recession could enable lower rates. Geopolitics risk. Whether Russia's war in Ukraine worsens or gets resolved in some capacity. Any flare-up boosts investor demand for safe havens like treasuries and sparks volatility in mortgage markets, though central banks would likely counter with support. Trade policy under the Biden administration and whether U.S. relations with China warm or face renewed tensions. Given China's enormous influence as holder of treasuries, deteriorating diplomatic ties spell trouble for U.S. borrowing costs and mortgage rates. So while mortgage rates don't feel directly in your control as a borrower, they do respond sensitively to inflation trends, Federal Reserve actions, geopolitics, and global investment patterns, all of which you can monitor to get a better sense of which way rates are headed in the years ahead as you manage your home financing. Now that you better understand what moves mortgage rates, what key indicators will you be watching most closely to predict whether rates might go up or down in the months ahead? How could the Fed's upcoming policy decisions impact mortgage rates later this year? Do you think central bankers should prioritize fighting inflation or supporting economic growth? Let me know in the comments section. If you enjoyed this video, don't forget to like, subscribe, and ring the notification bell to join the Billionaire Channel community for more videos on maximizing investments and achieve your money goals.